SCHD is a popular ETF among dividend investors, but now more than ever, the bigger question is, could SCHD be a nice hedge against stock market volatility? I have SCHD as part of my 3-fund freedom portfolio, and it's actually been very interesting as we've encountered some volatility in the stock market over the last couple of weeks. Like, for example, the rocky earnings call from the big tech companies that have sent the S&P 500 down at rates not seen since 2022. But every time we do see that pullback, whether it's recently or back in April, my funds such as QQQ and VTI, they go down, but SCHD tends to go up. Check it out. Back on July 17th, we have QQQM down 1.86%, VTI down 0.96%, and then SCHD is actually up 1%. Then, on July 24th, we have SCHD green on the daily chart, and you can see, of course, VTI, QQQM, and even SCHG is down. Then, July 25th, we have a slight recovery. With VTI, it's up 0.51. QQQM is down 0.01, but SCHD, there it is, up 0.77%. And it's kind of nice. You know, when of course the other ones like QQQM and VTI and the S&P 500, when they're going up, of course SCHD is just kind of hanging out. Sometimes it goes down. But it's nice when the stock market is volatile that SCHD just continues to hold its own, potentially even going up. But there are 5 things that we need to unpack in today's video on how SCHD may serve as an effective hedge against stock market drops and volatility in the future. So make sure you share this video with other fans of SCHD that you know, and pay me a dividend in the form of liking the video. Let's get right to it. The beauty of SCHD, it lies in its dividends, but most importantly, the fact that they've continued to grow their dividend payout year after year, as you see right here. Now, this is especially important if you're somebody who is maybe financially independent, or you're retired, or by some means you're living off of your portfolio wealth. You want to live off those dividends, right? See, we have 2 lenses that we can look at before we get to the 5 key reasons SCHD may serve as an effective hedge. The first lens that we need to look at is somebody who's building their portfolio. So let's say you're younger, you can take on more risk. This is because, of course, you have more time on your hands. You can continue to grow and grow, even if the stock market does have a pullback. You can continue to invest. Those more aggressive funds will pay off over time, and they're typically tech heavy in the massive growth environment. The second lens that we need to look at is somebody who's close to retirement. Maybe they're also living off their portfolio early, or they just want a more conservative approach so they don't have to panic when the stocks do go down. And this is where something like dividend stocks or SCHD can help balance the drops of a portfolio, especially when you need that money for your everyday living in retirement. And of course, the key win on any investment strategy is to have enough money to invest in the first place, of course. And this means living below our means, not being chained to debt, and finding ways to increase our income. That allowing us to invest more so we can live an amazing life. So let's dig into the 5 ways that I've researched that SCHD might be actually an interesting way to hedge against those stock market dips. Number 1, first, lower volatility. Now, this is where we need to look at something called beta. If you're not familiar with beta, it's the measurement of the volatility of the fund. The higher the beta, the more volatile and risky it can be. Although high risk, high reward. Now, in the general stock market like the S&P 500, that beta is set to 1.0. So typically, anything with a beta of less than 1 has lower risk, and anything with a beta of 1 or higher is typically more risky. A great example of a high beta is our buddy Tesla. Take a look at this. The 24-month beta is set at 1.86. For an ETF, we look at ARKK, which has a beta of 1.83. Pretty high, considering 1 is kind of the standard, right in the middle. And of course, I know you're asking, well, where does SCHD fall in this whole game? Well, its current 5-year beta is only 0.76. So this is significantly lower than the S&P 500 beta of 1.0, which of course means SCHD is lower than the overall stock market, making it a more stable investment, especially during those turbulent times. The second thing, defensive holdings. So SCHD, it's comprised of high quality, dividend paying companies that have been around for a long time. And they're often found in more stable sectors such as financials, healthcare, and consumer staples. Now, these sectors typically perform better during those economic downtimes, which really obviously helps provide a buffer against market volatility. So if we look over here on Seeking Alpha, we can see their holdings breakdown as well as the top 10 holdings. And if you think about economic downturns and problems, right? Typically, people are still going to be buying things at places like Home Depot. They're going to need gas for their car at Chevron, and yes, even AbbVie. So these companies tend to be those staples we need despite what's happening in the markets, what's happening in the economy. Those are those type of conservative companies. Now, if we look at the sector breakdown, financials, healthcare, consumer defensive, they lead the way on the holdings breakdown compared to your more volatile ETFs that might be technology heavy at this current moment. Now, the third thing to look at is the value and quality tilt. Now, similar to what I just mentioned, SCHD has a reliable tilt toward value and quality stocks. SCHD focuses on companies with strong profitability and conservative investment strategies, which tends to be more resilient during market downturns or market corrections. They also have a very specific requirement for dividend companies to be included in their ETF. And I've covered this many times on the channel, and I'll include a link in the description below so you can check it out, including their most recent dumping of AVGO, Broadcom. That's a really big company. And you think about AVGO being this big company, why would SCHD dump it? Because it didn't meet its actual requirements. And of course, that is a high volatile stock and it continues to grow and grow. So that isn't what the SCHD fund is all about. So during that annual reconstitution back in March of 2024, they offloaded. And as I mentioned, check out the description below. You can click on that link and check out all the details on why they did that in March of 2024. And will continue to do these things in future March time periods. Every year they do this. Now let's go into the fourth, which is my favorite, historical performance. See, historically, SCHD has managed to capture less of the market's downside. So for example, during periods of market declines, we typically see SCHD having smaller drawdowns compared to the broader market. And I'm comparing this to the S&P 500. Now, this defensive characteristic is partly due to the focus on mature dividend stocks, of course. But the comparison, when you put SCHD against something like VOO, and VOO, of course, tracks the S&P 500, it certainly shows a strong picture of the drawdowns of SCHD not being as wild as that of VOO. Then, for even more fun, if we compare SCHD to QQQ, you can see the drawdowns are quite crazy comparatively. Now let's go into the fifth one, and that's the diversified portfolio. And beyond the 10 stocks that we looked at earlier, SCHD holds a portfolio of 103 stocks altogether, which are known to have lower risk during downtimes. Now, I've been tracking the last 10 holdings of SCHD since back in December of 2023. We see things like Verizon, Amgen, and Broadcom, and they made up a sizable portfolio of the top 10 holdings on December 8th, 2023, but are much different if we compare it to June 28th, 2024, where Home Depot, Cisco, and AbbVie are the top three. This diversification recharacterization every March focuses on conservative funds, making this a very interesting ETF. But you may ask, well, what about bonds as a nice hedge? A lot of folks talk about bonds in their portfolio, notably Vanguard's ETF BND. And look, I think having a good hedge, or otherwise known as a conservative fund, in your three fund portfolio for financial independence is definitely worth considering. But I recommend that you do a little bit more research on bonds before you jump right in as that being your only hedge. Let me show you an example. If we go over to Seeking Alpha and we click on charting, we can plug in a total return for SCHD versus BND. Let's go take a look. All right, we can see here the SCHD is represented by the orange line, BND represented by the purple line. But here's what I'm really kind of stuck up against. If you look here, we can see a big difference in the last year alone. Look at SCHD, obviously outperforming BND. But more importantly, we want to look at how does this look in the next 5 years, 10 years. I always like to look into the future. You can't just look at a small snapshot. There's so much that happens within a year. Heck, there's so much that happens within 5 years that you can't really put all your eggs into that analysis. You got to look further out. So let's go to 10 years. Go to the last 10 years. It's almost hilarious that I'm even showing you this chart, but I really recommend if you're interested in bonds, do this. Go over to Seeking Alpha. I got a link in the description. Do some deep research. Use this stuff. Click right here where it says metrics. You can look at all these different metrics. You can truly do your own analysis to see, does this make sense in my portfolio or not? But when I'm looking at conservative funds and I look at something like SCHD with a total performance that includes dividends reinvested in the last 10 years of 196% total return compared to BND at only 15.7%, I think the answer is kind of obvious on where I'm leaning here. Now, if you even go back to the 5-year, look at the 5-year, that also worries me. Now, we know in the last 5 years, inflation has been absolutely out of control, much higher than it's been in the last 40 years previously, right? So take a look at this. Now, if you are living off your portfolio, which means, of course, you want stability in your cash. We can note that back in 2020, SCHD took a little bit of a nosedive during the COVID pandemic, but then it kind of recovers and now it's looking much better. And sure, you may have a little bit less stability with SCHD, but look at BND at only 0.30% during this time period. See, the issue here is inflation is eating up your money. Your ability to have purchasing power is lost as a result of BND only returning 0.30. So even though you've maintained your money, let's say you had $1 million into BND. Well, you get to kind of maintain that $1 million, but it's not really growing. You're just eating away at your portfolio in that particular fund. And by the way, your purchasing power due to inflation is also going down. To me, that's a tough one. That's a tough one to sell me on. I'd really like to get your thoughts. Comment down below and let's have a conversation. And what you need to do next is check out this video right here, and we'll see you on the next video.